China's collapse is far worse than you think. Cathie Wood. Over the past decades, the Chinese economy has risen at a miraculous growth rate to become an economic superpower. In human history, no other major economy has had an epic growth rate similar to that of China. But not everyone thinks the growth rate was organic and real. One of them is CEO of ARK Invest, Cathie Wood, who believes that the Chinese economic growth is a result of a real estate bubble similar to what was seen in Japan. Analogous to that of Japan's economy, which was driven by a real estate bubble, Wood believes that China's growth was driven by the housing bubble. In this video, we will find out more about Cathie's analysis of how the Chinese housing bubble is leading the economy into a slow but sure collapse. The housing bubble. China's rapid rise from an underdeveloped and poor nation to a major economic power is an excellent example of extraordinary development and progress. But the very spectacular growth is largely powered by a housing bubble, as the guru investor and CEO of ARK Invest believes. It all began when real estate developers borrowed enormous amounts of money to finance large real estate projects and to meet the growing housing demands. Developers built high-rise buildings, houses, and apartments without considering the due loans. Here came speculations. People started buying property with the hope that housing prices will appreciate in the future. The prices indeed did increase, but the speculations made housing in major cities out of the reach of middle-income Chinese, as the prices were skyrocketing. This made the Chinese middle class, which account for a large chunk of its population, look for housing outside of the major cities. Developers believed that the expansion from cities to peripheries would continue, so they pumped more money into it and built apartments, houses, theme parks, skyscrapers, and whatnot further outside the city. They became an abode for ghosts. Yes, these uninhabited, preemptively built cities are now known as ghost cities, since no human being lives there. This is living proof to the housing bubble, the very thing Wood is pointing out. So what are the other reasons which added up to cause the collapse in this major economic power? Collapse of the second largest economy. The founder of ARK Invest says that the Chinese economy is in far worse shape than most people realize. While Beijing has attempted to downplay the extent of the country's economic woes, Wood argues that the situation is actually much more dire. She points to a number of indicators, such as declining auto sales, falling real estate prices, and rising debt levels, which all point to an economy that is rapidly unraveling. Wood believes that the Chinese government will ultimately be forced to admit that the country is in a recession, and she expects that this will trigger a major global market sell-off. While some investors may see this as an opportunity to buy Chinese stocks at bargain prices, Wood warns that the situation could quickly spin out of control, leading to a full-blown financial crisis. As such, she advises caution when it comes to investing in China. In the recent months, Cathie Wood has been vocal about her concerns regarding the Chinese economy. In her view, the country is facing a number of serious challenges that could lead to significant problems down the road. For one thing, she believes that the Chinese government is not being transparent enough about its economic data. This lack of transparency makes it difficult to get an accurate picture of the country's true financial situation. Additionally, she points to the country's high levels of debt as another major concern. China's total debt has now reached $28 trillion, which is equal to more than 300% of its GDP. Such a large amount of debt increases the risk of a financial crisis and makes it difficult for the Chinese economy to grow. As a result, Wood believes that the Chinese economy is in bad shape and that investors should be cautious about investing in the country. So, how does the collapse in a major economic power affect other developing and developed economies? Let's discover. Wood predicts that the country's debt-ridden financial system will soon reach a breaking point, leading to a massive economic crash that will have far-reaching implications for the rest of the world. Although some experts have dismissed her claims as alarmist, her analysis raises important questions about the stability of the global economy. If China does indeed experience a major economic meltdown, it is sure to have devastating consequences for economies around the globe. Given the size of China's economy and its importance in global trade, a collapse would send shockwaves through the world financial system, causing a sharp decline in stock markets and triggering a wave of defaults on debt. The resulting recession would be severe, and it would likely take years for the global economy to recover. While it is impossible to say with certainty whether or not Wood's predictions will come true, her insights provide a sobering reminder of the fragility of the global economy and the interconnectedness of the world's finances. In such uncertain times, what can investors do to protect their portfolios from a potential Chinese collapse? Protecting portfolios in uncertainty. As China's economy continues to grow, more and more people are moving into cities and buying homes. This has led to a boom in the Chinese housing market, which has made prices soar. However, some experts are now warning that the Chinese housing market is in a bubble that could soon burst. If this happens, it could have major implications for the global economy. For investors, this means that it is important to be aware of the risks involved in investing in China. One way to protect your portfolio from a potential Chinese housing collapse is to diversify your investments. This means investing in a variety of assets, including stocks, bonds, and real estate. By spreading your investments across different asset classes, you can minimize your risk if one particular market crashes. For example, if the Chinese housing market does collapse, stocks and bonds will still be available as an investment option. Another way to protect your portfolio is to invest in companies that have a diversified customer base. Companies that rely heavily on China for revenue may be more likely to suffer if the Chinese economy slows down. Therefore, it is important to invest in companies that do business all over the world. This will insulate you from any potential problems in one particular country. Finally, keep in mind that no investment is without risk. Even if you take all of these precautions, there is still a chance that you could lose money if the Chinese housing market collapses. However, by being aware of the risks and taking steps to protect your portfolio, you can minimize your losses and maximize your chances of success. Conclusion: the Chinese economy is a major driver of global growth, and a collapse would have severe consequences for economies around the world. Investors need to be aware of the risks involved in investing in China, and they should diversify their portfolios to protect themselves from a potential housing market crash. However, even with these precautions, there is still some risk involved. Therefore, it is important to keep in mind that no investment is without risk. Thank you for watching. If you found the video to be informative and valuable, then feel free to like and share the video. And don't forget to subscribe to our channel. Thanks for watching.